Hello, YouTube family. Welcome to another live stream. So today we're going to break down the U.S. market. But first of all, I want to say happy holidays to everyone who's watching our live stream. My guest today is a bit late, few minutes late. So I'm just I'm just gonna check with him in a minute back and see if he how far how soon can he log in. In the meanwhile, in today's video, some of the topics that I want to cover today would be I want to look at the overall US market. So I want to look at what is going to happen in the US market for the next year. Things like inflation, interest rate, the overall stock market. We want to see if we want to see if the market is overvalued or undervalued. And we want to check like what the feds are going to do. Now we have some stocks we want to look at versus ETFs, and we'll make a comparison. What is the best thing to do right now in this environment? And also, we're gonna take a look at the AI bubble. Currently, the AI bubble is a new thing. So we're gonna show you look at the AI bubble and Amazon versus Microsoft. We're gonna make some comparisons there. Now, our speaker is here, our guest, Mr. Ruan Francis, and I think he's a perfect person to introduce himself. I know him from a very long time, from the days of we being in the investment club at UE. He's a very he's a very smart person when it comes to investment, but entrepreneur and a research analyst. But Ruan, would you like to introduce yourself to the audience tonight again? I guess we have you a few times before.
Well, you hear me clearly, Lance?
Yeah, we're hearing you clearly.
Yeah, so Rowan, everyone who knows me, and research analyst by day and entrepreneur by night, I would say. Basically, that's just me.
Mention the agenda that I mentioned the agenda a while ago. So we were talking about that we want to look at the pulse of the US market, things like the current US market conditions, inflations and earnings, and the overall market valuation. We want to look at what is the trend right now. There's a lot of talks right now when it comes down to AI bubble and the overall market. And we're gonna make a small comparison. Do we think people should invest in stocks versus ETF, things like that? And I want you to mention like your two top pick right now, if you have any stocks. But first, we're gonna go by the agenda first. So, what is your view and what is your market outlook right now? What is state of the market to you, and what do you foresee for 2026, Ruan?
So which market is talking about? You're talking about the global economy,
Oh, this. All
Jamaica.
right. So, all right. So, first of all, I want to say this. This episode is chiefly for the US market. And I'll be doing a live next week for the Jamaican market and my top picks for 2026 for the Jamaican market. Now, I want to put out a disclaimer here. Anything that we say or discuss on this live stream is strictly for entertainment purposes and educational purposes. So we're not licensed financial, or at least we're not your advisors to go and buy stock. So contact your financial advisor, and so you know that we're not liable for any decision you make. All right, Ron, you can go ahead.
Yeah, that being said, just
Yeah.
general information for us. It's not, we're not licensed to giving information to the public as such, and just for general information, basically. So my take
Yeah.
on since it's strictly U.S. economy, my take on the market is really and truly, we are late in a recession. If you understand how the cycles work, then you understand that the US market has actually been propped up by artificial liquidity provision since COVID-19. Since 2018, we really haven't seen a full market deleveraging. And as such, the market is very much expected to have some form of correction in the near future, probably within the next 4 quarters, etc. You should see valuation reverting back to the mean. But that being said, our speculation is just speculation. The Federal Reserve has made it clear that they are unwinding their balance sheet, which means that they won't be putting in much money more in the economy. They, even though cutting rates was driven by political pressure, the Fed has no incentive to continue to lower rates on these type of conditions because people are seeing where inflation is actually being resurfaced. The price of gold, where investors are positioning their portfolio, you can see that most investors are expecting some form of inflationary push. That being said, that's the side from the macroeconomic perspective, but from the market perspective, if you look at the market, the S&P 500 has 34% of its valuation in a few equities, such as the Magnificent Seven, and that comes with systematic risk for investors. This is nothing new because this is just a general way of how the market has operated for the last 300 years when it comes down to innovation. I don't know if you know financial history that well, but if you look at back the railroad innovation, we saw where railroads once command over 30% of the general market. And the boom when DuPont was running the markets, with the invention of plastic and chemicals, you have those commanding up to towards of 34% of the market. In the AI boom, you had the same thing in the 2000, where technology stocks were commanding upward of 40 to 34% of the market on a relative basis. So the AI boom is nothing new. Yes, there's a lot of fraud in the market regarding AI because there hasn't been a profitable model as yet.
All right, but one thing I would say though, yeah, thanks for that, Ruan. But just to rebut a bit of what you say, so as currently, as you mentioned about inflation, inflation is around 2.6%, if or somewhere there about, and the Fed target is around 2%. Now in May, when Donald Trump, when there is a time, I think in May there's supposed to be a new Fed chairman, and my estimation is that Donald Trump, the president, he will push someone who is more favorable in lowering the interest rate. Do you agree? And if such a person should come in to be the new chairman, I think would could that be a potential catalyst to basically push to inflate the stock market, and then probably can lead to more bubbles in the market, and then probably that can be lead to something of a more of a crash down the road, maybe a year or two. What do you think about that aspect?
So thank you. Yeah, so I read recent fairly today. I read an article where he's talking about installing a new federal chairman who is very much interested in handling the interest rate to a lower. So he's thinking about mortgage rates for his demographic of voters, etc. But one need to understand there's a general reason why the Federal Reserve has remained independent of the political environment or the president. And that's because when it comes down to macroeconomic conditions and in monetary policies, it's very imperative for the central bank to be separate from the government. And that because political leaders do have an incentive for Goldilocks environment across the board. They want to see the environment, low interest rate, job stability, but that comes with the propensity of overheating of the economy. And that's a problem. Um, Currently, the last estimate for the US annual inflation rate was 2.7%, coming all the way from 6.5 with the COVID. That was more of a demand pull based upon value chain bottlenecks and all that. But the average is normally 2% across the board for over a long time. But inflation is expected to rise currently based upon condition. A lower interest rate has the propensity of increasing valuation that are already overvalued and from a historical perspective. So that would draw a catalyst to an overvalued market and then a recession.
Yeah.
So
Okay.
mhm.
Yeah, yeah, fair enough. So, well, what I'm looking at is another other aspect too, is that with currently the U.S. government, they say is like they say the government make $5, they are actually paying out $7. In the long term, I guess that will lead to the dollar. But this is a very touchy subject because, as you know, the U.S. dollar is a reserve currency, and I don't know. I think we are in some times that have never been seen. Not even Warren Buffett, maybe as this I've seen any time like this. Because at this moment, Warren Buffett has a very large amount of cash, according to what I'm reading. Like I don't remember the figure, but like $400 billion in cash, something like that. I don't know if you know the figure. You follow Berkshire Hathaway, but
Yeah, it's around between 450 to 400 billion. Greg is now who's now the CEO of Berkshire Hathaway. He's responsible of deploying that. One needs to understand that empires do rise and decline, and that's the nature of empires. The US has had a very much strong position geopolitically because of being the reserve dollar and being the reserve currency. Approximately 70% of US dollar doesn't circulate in the US economies outside
yeah,
and central bank balance sheet. Obviously, persons are gonna move away if it's a depreciation in the US dollar. And the US dollar will depreciate because it's the nature of fiat currency. That being said, everything is incumbent upon the natural conditions of whether or not the US is losing its supremacy in the global trade. The dollar is still the world reserve currency, is still the most traded currency in commodities. While we see the Chinese, remember, is taking a more strategic growth for investors who are trading with China. It hasn't overtaken the dollar as yet. But great nations do decline because of debt. And that's what the problem that the US is in. The debt is growing faster than the income of the central government. And as such, the government has very much been dependent upon more debt being issued to the public to pay its debt. And that's a very, very bad position to be in. And strategically, it's bad for the US, especially for development of a new AI race, um, ensuring that there's productivity and persons are able to move up in the middle class. The American society doesn't have a middle class now. It's harder for anyone to rise in the middle class in the US right now than any other time in history. And we're not talking about like Jamaica, who we know is a third world country. It's very much improbable for most persons to ride up to the rich class. So yes, it is in a very bad position. The US is in a very bad position. However, I hope it is resolved because we are very much dependent upon the US, and the US won't take a decline like other nations. There will be wars, and the wars won't
yeah,
be a good one because you have nuclear power, nuclear armed country falling. We don't know how the US is gonna take that. If it's gonna take it easy, like how the British has took it, because the British was great as the US. The Roman Empire was as well great.
okay. Yeah, thank you for that. Yeah, but what I see though is that at this time I say basically US government, if a war should start right now, they would be in a big problem. But because they basically are borrowing, and you probably have to borrow more to pay back the debt. But that's
The
for another day.
Right. So,
Yeah.
as I already stated, being a real reserve currency, you're able to monetize your debt in your own currency, and that comes with a lot of leverage. It's not like the US is dependent up on other nations to devalue their currencies to pay in dollars, like what we see happen to Turkey and other countries, the Argentina bonds, where they had to convert their currency into US dollars to pay their debt. So being the real reserve currency, you can print in your own currency and pay your debt, but that comes with the natural course of a depreciation in dollar.
But yeah, that's what I'm privy to that. That no, but how long can they do that though? How long can they borrow? That's the question.
Once US remain the global geopolitical stronghold, they are able to do
And
that.
mhm.
Japan has increased its debt by 200%. If anyone would have told on one of the macroeconomists that hey, Japan would be able to do that and sustain it over a long period, no one could believe that, and that's because of their inflection point within their population. The pyramid actually turned upside down, so they have more seniority. They have more senior citizens that they had to be taken care of, and that caused them to increase their debt. A lot of countries are going the same trajectory. Even the US, they're having low birth rate. Those are some demographic factors as well that can cause a country to increase its debt and then therefore increase its exposure to long-term currency devaluation.
Fair, yeah, fair enough. I like that point. So next we want to discuss about the next thing on our agenda we want to speak about is, so we already look at the US market and mention about the Magnificent Seven having 34 34% of the entire S&P 500. That mean, in my summation, I would say to what I could say basically probably there are good stocks still out there on the US market. So because if those stocks are inflated and take up 35% of the entire S&P, that mean that you might have some stocks that are overlooked with fair value or discounted value. So I don't know if you believe in have that same belief. And what you think about ETFs also? So those are basically two questions. If the Magnificent Seven
All
would take
right.
up,
Since you're at that, let's deal with the valuation of the market first before we move on to strategic asset pick or invest in the ETF. I did send you some pictures, so you can put them up. Let's just have give the audience a view of how the market is right now, because those are the most recent data.
mm, are you seeing it?
I'm not seeing it on
You,
the screen. Yeah, I'm
you
seeing
see?
it now. Let's start with what's your other picture you have?
Let me put it up. Um,
Oh yes, so let's start with that. So of the Magnificent Seven since 2015, we can see that they represented a very small percentage of the market capitalism. They're about approximately 11%, they're about 13%. But if you look down all the way down to 2025, you see out of 40 trillion of the S&P 500, we have 21 trillion representing the Magnificent Seven. That a reversion to the mean, so a decline of 33%, 34% would mean that the S&P part of the market would generally decline by a significant level. Um, that being said, then you have the mechanistical aspect of the market where you have leverage unwinding, broker book, call rates, etc. That would even sink the market more. So the valuation is a very imperative thing. While you're able to invest in companies like Nvidia, who is known to be one of the most important companies in the AI arms race in developing the critical component of the chips for training models. Valuation is important because you can temporarily impair your capital, which has happened to most investors with Microsoft back in the AI boom, where they have to wait up to 20 years to even reach the valuation that they bought at. So for investors, it's very important to understand the nature of valuation.
yeah,
That mhm. I think I did send another chart. So since you understand the
yeah.
concept of
You send me this chart also.
yeah, so
Yeah,
this
you want to, yeah,
so this
continue.
chart this chart now is what Warren Buffett used to judge the market over a long period of time to see if the market is significantly overvalued or not. Over the long run, the stock market track the GDP growth rate. When the market is significantly higher than stock market significantly higher than the GDP of a country, it's a very high probabilistically the market will revert back to the mean. And that's what this is showing. Two standard
So we're
deviation. The market actually broke out of a two standard deviations since the 1950. with this current level of valuation, the highest it has ever been over the last so for instance 5 to 10 decades. If you can look at it, if you look at 2000, you see the dot-com boom came off with two standard deviation. Even the boom of the railroads and the other infrastructure, the telecom boom like AT&T and all those companies, they revert off the standard deviation. But this valuation now is significantly outside of two standard deviation band, where money investors are seeing that the market is significantly overvalued. A lot of persons don't understand AI. To understand AI and understand the valuation, AI, there has been a significant shift in the general composition of the entire global stock market, where you have a winner take all model for most IT companies. IT companies are significantly different from traditional companies. IT companies, they have no marginal cost in replicating, and such you're able to scale at higher margin, and their valuation warrants a higher percentage they're called information goods, and standard goods stocks are stocks that are, they have a production cycle like normal cycle, and they have marginal costs where they increase their marginal cost for each product, and such they have to capitalize for the expenses. AI companies, information technology companies don't have that. They're able to scale infinitely because of their structure, and they're just clearly software goods. The problem with AI is not a software company as many persons think it is. Is between the band between information goods and traditional goods. To build the software, it falls in the bandwidth of being um information goods, but it costs for each model to train and for each model to operate. As such, it's not able to scale without a lot of expenses because you have marginal costs for each prompt you make to an AI product. And as such, many persons doesn't factor in that, and they end up putting valuation on companies that are not profitable in regards to using AI.
Okay, so essentially, are you basically saying that the race that these companies are in for AI is justified then? Because they
It is
want to
just
win.
voila. So okay, so if you understand the software industry, there are some companies that there are certain companies that capture a vast economic rent of a value chain ecosystem. That is that companies that are software enterprise software companies, they are able to use artificial intelligence to increase value proposition, increase productivity, and as such, they are more strategically positioned to earn a lot more AI products and being chatbots like ChatGPT. ChatGPT has figured out that they're not gonna make a lot of money and being a chat box, but by strategically positioning themselves in the enterprise race, and that's why they went into a strategic joint venture with Microsoft to leverage ChatGPT across their ecosystem. Anthropic is another company. They are also realizing that chatbox doesn't make a lot of money because retail customers not gonna pay more than $30 per month per subscription for chatbox, and they cannot infinitely subsidize the market to create a cascading effect, a network effect when it comes down to a chatbox.
So,
So that's
okay,
the
so what
problem.
about, so ChatGPT in the lead and Google? What about
No,
Gemini, Google?
Gemini, the Google is in the lead. Many persons have this information wrong. ChatGPT is in the lead for retail investors, retail customers. But if you look at the last training models for generative AI goods, you realize that ChatGPT models are performing exceptionally well, as well as Gen AI 3. People
Better
need,
than
yeah,
Gem.
so Google AI product is performing better now than ChatGPT, the recent release.
Okay. Yeah, I know that Google they said that Google had the technology like even
Yeah,
before.
yeah. Google was the one who did the article, and Google was the one who wrote the technical paper that Sam Altman used to start um, the company.
Yeah, they just were basically. I heard that they were basically just scared to release it, and then somebody just and then OpenAI just come and just take it up. So Google have the money to scale and the
All right,
free
so
cash flow.
yes, Google have a better infrastructure to scale, and most persons believe that Google's gonna win this AI race. They have the enterprise software, and they have the retail aspect, which is in their under our ecosystem. And by doing that, you're seeing where they're able to capture a lot of percentage of the marketplace than ordinary in AI companies who don't have that infrastructure or economies of scale. So to
Yeah.
understand that they are in the strong in enterprise level software, they're strong in the operating system with Android ecosystem. They're strong in the cloud services, Google Cloud. So they have a broader ecosystem to tie in their services into than ChatGPT. ChatGPT, I have to make strategic partners with Microsoft, Amazon, and all those companies to leverage their product. I think Anthropic is going with Amazon as they're making their Amazon investments in them.
So Amazon basically is playing their their share
Yes,
too.
most companies are doing joint ventures, as it's very expensive to develop the system in house. But as a person's, so it comes down to a more strategic question: when do these companies open their models so other persons can use it? Many persons are not opening their model on Facebook. Once open Lambda, but they close it back. The Lambda is their generative AI model, but they're scared of the Chinese because once they train the model once, persons can take the model and build upon it, and they got billions of resources for a model that you spend billions to train. So it comes down to who's open it, who's willing to do joint venture, etc. But the AI race is very expensive, and most companies can't afford it, so they rather go into a joint venture with ChatGPT. But
Fair.
Google's a leader when it comes down to it. Not the person's order. They own DeepMind, who solve one of the most complex biological ecosystem in history, where they're able to do the protein unfolding that helps to solve many cases when it comes down to drugs and development of different biological products to aid like cancer research, etc. And Google has been at the forefront when it comes down to AI products.
Alright then. So being that you touch on the AI, I just want to cover fully the AI aspect before we go to the stock pick. So like basically in like Amazon versus Microsoft, who would be your pick in that in those two company right now?
That's a
And we
hard
can look
pick.
at the balance sheet if I
So do
want
I,
to.
do I have to pick?
Drop.
Yeah, you can pull up the balance sheet.
If you,
But if you pull up the balance sheet, then you have to do return on equity and return on assets. Um, that being said, personally, it depends on where. Because if I have to pick one, I would go with Microsoft, and that's the reason.
why?
Microsoft does operate at a higher margin than Amazon. They are in the cloud services space, which is a high margin business as well. They have the Microsoft suite with that they're able to bundle across their ecosystem. They are in a stronger position when it comes down to long term execution and long term return on capital for investors. If I wanted to be in the logistics space or in the retail space, I would have to go with Amazon. But have been in the retail space comes a lot with a lot of fixed costs, a lot of expenses, and other such that comes with higher margin compression over operating cycles than a general software company like Microsoft. If you're looking at return on capital to investors,
Yes. So you're seeing my screen.
no, not no.
I'm not seeing it. Oh God.
Mm-mm.
Wait. Oh, just realized what the problem is. Oh yeah, you're seeing it now.
Mm-hmm.
So basically, this is Microsoft balance sheet. But if you look at the ratios,
Just click on
if you look at the
statistics. There's a click on statistics, right? Beside financials and statistics.
yeah, statistics.
Mm-hmm.
This is statistics for Microsoft. They actually pay out dividend also.
They have,
Uh, I was looking at their price to operating cash flow 24, price to free cash flow 46, peg ratio 2. But as I said, still, Microsoft, the consensus is that even though the PE is 33, if you look at where the company can reach, to me, it's still it's a solid company. Me, I don't think
oh,
it's overvalued.
what's his return on equity? What's the return on assets? Are you seeing it there? It's supposed to be there.
I can look for it. Return on equity. Oh, return on asset is 14.66%.
Return on equity is 32%, right? And
Yeah.
look at the gross margin and the gross operating margin, 46 and 68.
Mm.
And
Yeah.
pull up and free cash flow margin of 26. If I'm looking good.
Yeah.
All right, pull up Amazon now. You see a different metric because of the nature of the business model.
But yeah. I
So you
think they
understand what I
rate Google is have a triple rating. We call it the rating again with the
um
government rating triple B. Triple B?
credit rating you're talking about?
The credit rating. They have the
Mm.
highest rating in like the US market. But this is Amazon.
Oh yeah, scroll on to the bottom. Scroll on to wipe on the bottom. Scroll on to the end. Yeah. See the
Uh
margins. If you look at the margins,
yeah,
operating
return on
margin is 11%. Um, so if you look at free cash flow margin, 1.53%, return on assets is 20, return on equity is 24%. So on a return basis, you can see where Microsoft is more profitable. I didn't look at the metrics, but having an understanding of the economics of the businesses, I could have told you that Microsoft would be a long-term play for me. I would be a better buy than Amazon. But Amazon
yeah.
has built out a scalable barrier to entry, and
Yeah,
everything
yeah.
comes down to in how you're thinking about structuring your investment portfolio or what you want to have it. You can't have all tech as the company. Um, but also I could tell you that Microsoft is also a very formidable force in enterprise software as well. So mm. everything comes back down to valuation. Which one can you get at the cheaper rate, and then you can
Well,
make a
that's
decision
true.
and
That's true. I
invest.
think maybe valuation wise, Amazon might be a bit cheaper right now.
So if it's
But
cheaper, mm,
well, I think it probably Microsoft. After I think what I might have to do is run a discounted cash flow because that will ultimately determine who probably is.
mm. I mean,
Because
a discounted cash flow isn't necessarily if you understand, like, for example, price of free cash flow. Um, if you're getting from an absolute level, if Amazon is cheaper and is selling significant lower multiples than Microsoft, and the market is below the market averages of what they paid for it in the past, then there's a high probability that the catalyst will be going forward. It will increase. So the disconnect between the disconnect between the valuation and the target price can also be a catalyst out separately from once the business remain constant, meaning that the underlying economics has not eroded. If you understand what I'm
that's true.
saying.
I
Yeah.
understand what you're saying,
Mm,
but what
mm,
I'm saying, why I think I would do because all right, I just think probably Microsoft would probably generate more cash in the future
mhm.
based off what they are doing. But Amazon is a good company too, notwithstanding that. So, but I understand what you're saying though. It's just
All right.
up to who
I'm gonna
probably.
teach you how to trick land. Sometimes I don't even have to run a discounted cash flow, right? Um
Yeah, yeah,
so for instance, the return on equity for Amazon is about 26%, right? The
yeah, yeah,
26%. So we know for a fact at 26%, the business underlying economics remain the same, right?
yeah, yeah,
So if the business economics remain the same, is 26%, we know that within approximately 3 years, the value equity, the residual net worth of the stockholders would increase twice, double within 3 years. If we're
mm.
selling at low multiples, just by being in a business play, you don't need to do a cash dividend, a DCF. Putting all these projections, once the business underlying economics remain the same, the, the equity position is gonna increase twice over the next 3 years. It's a buy. So
No, yeah, yeah,
mo-
of course.
it's a majority of the time the complexities in finance, as Warren Buffett have talked about, it doesn't make
Yeah,
sense
yeah, true,
because
true.
because
Sometimes,
most of this come from Plutonic physicists who came into the U.S. market and come with the complexities. Oftentimes, you can just look, if you're studying stocks and you're reading financial statements and understanding business models, oftentimes you're gonna see value that it's just no brainer.
You don't have to run a cash
You,
flow
you don't
statement.
have to.
You
For
don't have
instance,
to. But it's
one of
just
my
that if you maybe want to go to the two to the T and say you want the ultimate prediction or whatever, or
mm,
you want to predict to the T. But
uh,
I really and truly, if I look at the returns and those stats and the price to cash flow and those things, I can already get a picture of it for real.
yeah.
But so also no one more thing. So who is your top two stat now that you're watching
Oh,
the
in the US,
most?
so I'm looking at Adobe. It's doing since I've been watching it since Adobe and Black. Black is queer, really run by Jack Dorsey. They're building out the operating system for SMEs, businesses, and the payment infrastructure, front end play wall, and all of that. So operating infrastructure for any industry, small businesses across the US. And Adobe have a very strong strategic position. While many persons sold on the stock because of the Figma, they wanted to buy Figma because Figma is coming to their market space regarding their enterprise software development level. But they don't need Figma. Adobe is a very powerful ecosystem on its own, and they already bought a company that can develop the same infrastructure as Figma, and they have the cash, strong balance sheet, strong returns, just like Amazon and Microsoft, and all of that. So those were two companies I'm looking at. Outside of technology, I've seen companies like well, the market has just adjusted to those levels, but I was looking at companies in the real estate and in the not so flashy markets such as waste management and disposable companies that are selling way below intrinsic value.
Which company repeat? The waste management
Waste
company?
management. It's
That's the
called
name. Oh yeah, yeah.
Mm.
What that's the name?
I think it's called United Waste. It's an
Oh,
American.
United Way. You continue.
Yeah, I don't want to store stock quotes in my.
No, no, that's fine. That's fine. Just the name. In case more
Mhm.
if you look at the company, you know.
Well,
Yes,
yeah. Oh well, you can look out. You can just link me. I tell the name still. Cause I have it
United,
in my watch list.
United,
I think it's United
United.
Waste, if I'm correct. But it's a waste management company. But the market has recently, over the last 6 months, has pushed the stock up about a lot of percentage points. So, because I guess a lot of persons were saying, hey, that's what the Mr. Market does. The market sometimes disconnect. Everybody was running to tech. But no, when they realize that Nvidia is overvalued because it have a capacity constraint, people are
Yeah.
at 40 times. Nvidia is priced at 42 times um sales. Meaning selling 42 times the sale. Just think about that. To reach that
Whoa.
level, the company has to increase its revenue 42 sales currently by 42 times.
Listen, Nvidia is a great company, but it's clearly overvalued. Clearly.
I mean, you don't need to come from space to
You
realize
don't
that.
have to
So,
use
so the
it's
market
clearly
is realizing that and dropping it. Well, if you drop to the 150 level, you can buy it if you want to be a whole long-term buyer, but it's too overvalued now.
yeah.
So, which two companies in the US you're looking at?
Currently I was looking at Microsoft, ironically.
Mm.
So I was doing a comparison between Microsoft and Amazon. Interestingly, otherwise from that, I was looking at a juice company called Celsius Holding. Have you ever
Mhm.
heard about that
Yeah,
company?
man, no, man, they perform extra. No, they perform so well. Mm.
So they have a space in the functional health space as a fitness juice or energy juice. So they basically
Okay.
gonna be a competitor to Red Bull and Monster, and they have a high growth and they have a strategic partnership with Pepsi. Pepsi own a substantial, well, I mean, I think about 12% in their company, and
Mm.
Pepsi is incorporating them in their distribution network.
Mm.
So I'm looking at that company right now. Otherwise, from that,
What's your
I'm
what's
trying.
your what's your enterprise value to EBITDA? What's your
Um,
enterprise value to operating income now?
let me
If you
check it
know
out.
if you know the figure.
All right, so share screen. Hmm. Enterprise value. Is it the enterprise value?
Mm-hmm.
Enterprise value. Hmm. to EBITDA. Uh,
Yeah, I'm looking at it right now, and they're selling. If it's Celsius,
CELH.
it's a holding company.
Yeah, it's a holding
Mm,
company.
okay, they're selling at 55 time PE. Price of free cash flow is at 22. They have a strong
Yeah.
free cash flow margin, but their return on capital is very low. So for me personally, looking at the statistics, while I'm seeing here where they have a strong growth rate in their revenue base, meaning that there is a lot of potential for market penetration of their products. Um, Personally, for me, I would want to see the valuation come down. For me personally,
Yeah, which is why I'm watching and waiting. But as I said, it's me banking on their growth potential at the moment. Cause just like
yes.
Monster, you remember Monster, oh Monster grow back then.
Mm-hmm.
It's all about the growth. They're trading at a high PE, but as a startup company, that can be the case.
All right, so remember, you trade at a high PE for a manufacturing company. You'd have to understand what's um, their manufacturing logistics chain. Well, their gross margin is 52%, which is a very high one. You can see their operating margin is like 19 to 20%, and they're selling at 355 times PE, 22 times cash flow, free cash flow. While PE is a very, very much poor valuation of any company, um, that's very high. 355, and it's not an information goods company or a technical
No.
company. You have to consider how would that.
I
Mm,
personally I made a lot of money off this company, because I bought them and sell out of this company. So I think I made around 80% back when it was like $20 something like that. But I
You
still
bought
have
them
like
last year.
yeah, I think it was the year before. But
Mm,
I don't remember exact year. I think 2023 late or so. But I have a small holding in it. But even the small holding I have is still up like about 18%. But it
mhm.
might, as I said before, I'm watching it, looking might be a time to sell or increase. But I'm just checking it out back right now. Just started to check it out back. Yeah.
Well, they don't have a debt and they have a lot of cash on their balance sheet. And again, valuation is a very important thing. And I'm not seeing how they to meet this valuation, they have to increase their revenue by at least 100% year over year to meet it in the next 5 years. I'm not seeing that. So
Yeah. Increase it in the next year.
yeah, 100% year over year increase to reach a
I mean,
350.
they can increase 50%. I mean, as I said,
But the
they're a
component the
fast growing
component
company.
annual the component annual growth rate for the last 10 years is 61, and 5 years 77%. So I'm not seeing where the
It
355
it's
valuation.
all
Maybe I'm
about if they
wrong.
can. Maybe I see thing about it is that maybe the growth has slowed a bit, but it's up. If the distribution deal with Pepsi, I go help them to scale faster. Remember, say Pepsi is all over the world. Let's say Pepsi can bring them to more countries internationally, and they can get a high growth rate, increase their revenue by more than 70% per year. Probably it can be justified for like the next 5 to 10 years, but it's
You see
something to
now,
watch and
you're struggling with what we call of recency bias. So because you make some money, sweet you're holding on to it because you say, well, they can grow, but from a rational perspective, the valuation is very rich. So I guess they have to deliver.
no, yeah, definitely, definitely. Right now, I think I would go more with the
You better you sell it and go, even Microsoft is selling cheaper.
Microsoft. I think I would go more with Microsoft at the moment because
So,
I was looking at Microsoft on Amazon, and I think I see more growth potential for Amazon for Microsoft,
mhm.
like to grow. So it's just that they're spending a lot of money on the whole AI infrastructure thing, and I think they have partnership with OpenAI.
Yeah, they
Cause
have up.
OpenAI buy Azure cloud from them and all of that strategic partnership. So yeah. But as I said, it's a thing to cut from a portfolio. I have to do it.
Lance, one thing I've understand over the years of studying investment is that the price they pay for equity, while it's a very good business, it's very good to buy a wonderful business at a fair price than buy even a wonderful business at an expensive price. The price that you pay have a lot to do to how much your return on capital is as an investor. And that what many persons don't understand. Sometimes you just have to wait for the disconnect between the market and the price. You can buy subpar companies at low multiples and make crazy money than people buying great companies at a very expensive price. It's just a law of
Agree.
mathematics.
I agree with you. I agree with
Mm.
you. But what industry you think outside tech that maybe everybody is overlooking?
Also, have tech now.
Yeah.
So there's a company that I was looking at. Let me just pull it up because sometimes I don't remember the names, the ticker names. Let's just put it up. Let's just on my watch list.
They can share your screen too, if you see the option.
No man, I think I wanna share my screen. My screen messy. Um, so- there. Let me see if I can pull it up for you.
In the chat, if anyone tuning in, if persons who are tuning in, type in who you prefer, Amazon or Microsoft. Just
Mm.
drop it in the comment section.
Oh yeah, so the company I was looking at, yeah, it's Travelers. I don't know if you ever heard of them.
I hear
Um,
the name already.
yeah,
But
they are a financial conglomerate. They provide commercial and property casualty insurance products. Um, when I was looking at them, they were selling below book value, but their price has increased astronomically since last year. They're up around 84% thereabout when I was looking at them. Let me see. Not sure if I can share my screen. Let me see. So pull up statistics. Alright, mm, let's share this. What about if you share the screen, Lance?
let's see, there's a presenter invite.
Oh, presenter. Okay. Share screen. Share screen. Hold on. You see my screen now?
No, you're gonna add the stage. Press add the stage.
Oh, okay. Let me know if you see the screen. You see the screen now?
Oh, I'm added. I'm added. All right. I'm seeing it now.
Yeah, so this is Travelers. When I was looking at it from last year, it was down here earlier in the year. It was way below book value when I saw it, but now it's up. The market has realized the value, but they're actually in the insurance space, insurance market. They have a lot of cash flow coming in, and they have a lot of cash flow coming in on their balance sheet. And for insurance company, they're not heavily leveraged. They're below the 40% debt to equity leverage aspect. Have a strong position in the market. Been in the market for since the 18th century as insurance company. Um, was in. I don't know if you understand the business model of insurance, but they have a lot of money coming in. They invest back the money. They
Yeah.
pay it. Yeah, exactly. It's a very good company. When I was looking at it, I think it was.
So the PE at for insurance company, return on assets gonna play a bigger role in the
Yeah, return
valuation.
on yeah return on asset is very
What the
important.
return on assets?
Um,
Three
they're
percent.
at 3% on average for the last
That
5 years.
that not too bad for that good for insurance company.
No, well, their return on net tangible assets, meaning that outside of their goodwill and intangibles and IT infrastructure, is 16. So they
Wow.
so right there we know they're above the cost of capital.
Yeah,
Um,
yeah.
so the return on equity is around 15%, and by at 15%, investors can double over the next 5 years can double their equity position from a network perspective. So it's a
Yeah.
very strong company. I always
So
have a lot of
what type of insurance is it they do? It obviously provide commercial and personal property casualty product and service business. Yeah,
so
it
they're
seem
in,
like a big company.
Yeah, they're in the
Well,
intro.
but the
Go ahead.
enterprise value market cap 65 billion.
Yeah,
Enterprise value
the market cap
34.
it has. Uh, Go ahead.
Continue, continue.
Yeah, the market cap it is about 65 billion and their enterprise value is 74, which means that on average they have about $10 billion in debt, which is not bad for their position because they have
Mm.
8% in net debt and they have a lot of cash laying around. Um, to understand an insurance company, they invest a lot of money. So to have that amount of money laying around, they are a strong company. They have a net cash flow margin of 20%. That's 20% of their revenue convert into cash after they operating and paying out after they paying out their casualty claims and all of that.
Okay, okay. All right, that's so. It sound like a good company. Good
No
hardly.
man,
You know,
there's
'cause the bank, them not good. The bank, American bank. I don't think the last time I checked, they're so hot right now. Even Bank of America, cause
I
even
mean,
Warren Buffett sell out all of his position. We don't know why he did that, but he sell out basically all of his position, right? If I'm wrong, I'm wrong. I know you follow Berkshire.
well, I cannot tell you the reason behind. Remember, Warren Buffett. It's not Warren Buffett. You have to understand there's Greg Abel and another investor who manages the investment portfolio as well, along with Greg. Um, you, you have to understand that there's many reasons why they probably sell out. Opportunity cost of capital. We don't think that's the case. We think that maybe they believe that the market is overvalued and the banks are gonna be hit based upon their exposure and so forth. They probably sell out.
Hmm. Interesting stuff. All right, so two more things we also address, and then basically we can call it a night. Um, so right now there are several options. I would say we're not giving anybody any option or telling them what to do, but what are the options now investors have in this new year? So I would lay it out and say continue buying at the stock market. You have can say all right, buying at ETFs, or you can look into gold or silver.
I
What
would I
tactically? What are you saying now?
Well, personally, if I was I'm able because I've been studying the market for so much years, I'm able to structure a portfolio that can help you to make money in any weather, any condition. But it comes with trade-off. So if you're looking at ETF, I would say go with the Vanguard Value Fund. That is more less exposed to technology. You could put 5% in the GLD, which is the goal, um, and you can put some into short-term treasury ETF. And you can play if you want. You can always ask me, and I'll just tell you the five ETF you can do, how you structure your position. If the market decline, people are gonna move to short-term bonds. That is gonna go up. People are gonna move to value. The value might go down temporarily, but it's gonna increase because the value is gonna have a lower price to book value and PE ratio than technology, and so forth. So it's easy for you to make money in the market, but have a higher position always in equities. And just play it for the long run. If you invest in ETF, you'll make a lot more money than even professional investors. Because people with their CFA can't beat the market. People with their MBA can't beat the market. They can't beat the ETF. That's returning 8%, 9% per annum. And that's because of many cognitive biases and people don't know how to select equities and they don't know how to think about equities and they follow the crowd and all of that. So if you know you have money every month that you can invest in the US market, it's easy to structure an investment portfolio that earns money over the long run.
You like that? I like that. Thank. Yeah. Which other question is I wanted to tackle? One more thing. So we say we mentioned the allocation. Uh, yeah. So I think basically we cover most of what we wanted to talk about. So look at the overall market and we see where the market is going, and a lot of things are playing out geopolitically. But at the end of the day, you have to be strategic as an investor in the US market.
All right, so
So
there's many weak. We call these when you're doing research. You call these weak signals. When countries are in problem and when the good days are over, they oftentimes start to do a thing that they call resource grabbing, because over time they're realizing that the operating structure of your country, they're gonna need some resources to stay competitive and stay ahead. So the geopolitical tensions that you see is a natural course in when a dominant country is being challenged. The US is being challenged globally, geopolitically. China control almost all the most important minerals and resources when it comes down to the AI race and building chips and infrastructure. China is dominating in building infrastructure at a faster level than the US. China is dominating globally in how they structure their company, in having strong affiliation. So they're dominating. I would say personally, while the US have the lead in research, China has a dominant position in execution. There hasn't been no other country that has been executed technology as China has. So there's not. So even though the best PhDs are being taught in the US, China is they go back to China and they execute. So many you may have many headwinds with the US. You have internal conflicts. You have things of immigration concern. You're gonna have internal conflict, which is very bad for the US. So strategically, the US is still the most dominant force because of its military position. The dollar is dominant, but if the US can't get along internally, if they cannot reassure the world within the next 10 years, they're gonna be in more deeper problem. They're gonna be more resource grabbing. So Venezuela is not gonna be the first case. They're gonna be a lot more resource grabbing across.
So you actually think they're gonna invade Venezuela then?
Well, to invade Venezuela is not easy as many persons think it is. While many
I know
persons,
the mountains,
not even no, you're talking about
geography and all of that.
even that. If the problem with it, with invading Venezuela, it gonna comes at a cost to the US, and the cost not may not even be militarily, but it will be geopolitically. And if China and Russia really stand behind Venezuela, it can be a bad thing for the Caribbean. Um, we're gonna get drawn into it whether we like it or not, and it's gonna be a strong geopolitical tug and war between we and the East and all of that. So really and truly, I hope they can come to a solution and they move forward. But
All right.
it's
Yeah.
really a resource grabbing thing. So, but the US, if the US is successful, Jamaica is successful. Let's say it as that, and most of us is gonna cheer for the US regardless.
That's
We
true. That's true.
a high percentage of our GDP come from
The
the
US.
US. It's
If
linked.
US if
It's
US
linked.
fail, if US fail, Jamaica is going to
Yeah, the
fail.
US is not gonna fail, but if the US struggles, Jamaica struggles. That's just basically it.
Yeah,
We don't
cause
have,
we're so
yeah, we don't have
dependent on tourism.
not even tourism and remittance. We don't have a diversified economy. Well, outside of that debate, but Jamaica is heading towards Haiti. I can just say that for sure. That's how pessimistic I am. But thanks for having me, Lance.
Yeah, so thanks. Yeah, for sure. It was a pleasure, having you on the channel again. Thanks to everybody to all who tune in to watch us. You can rewatch. I will try to repurpose some of the clips that persons can watch at specific talk points. But thanks to everyone that showed up and watched tonight. Holds right now. So good night.
Ah, peace, Lance.